My name is Milton Ezrati. I am Chief Economist for Vested. I think the economy is running out of room. The pace at which we're growing now is historically sustainable. The problem is that we have been growing for so many years, albeit very slowly in part of that, growing for so many years that we are running out of space. And the two things I would point to are the unemployment rate, first of all. It is historic lows. At this rate, we're going to run out of trained labor. And already American industry and business is complaining that they can't get trained labor. And that will set a limit on how far or how fast the economy is growing. The other thing that's happened is that during the 8 years after the Great Recession, American industry spent very little on new investment, so that a lot of our equipment, intellectual capital, and premises are old. The utilization of that is full, or virtually full, at least in terms of historic norms, and that too sets a limit on how fast and how far the economy can go. I think the immigration question cuts two ways. We are not running out of unskilled labor. So to the extent that the immigrant population largely lacks skill, whether it's language skills or technical skills for work, they're not going to help us in this situation. To the extent that the immigrant population has skills, limiting that flow, of course, limits the economy's ability to grow. Now, I know that the popular media and the president certainly has indicated that most of the immigrants are unskilled or even illegal in the sense of criminals. That's the way Trump talks about it. But the statistics show that a great portion of the immigrant population coming into the United States is actually fairly well educated and ambitious. Limiting that flow would definitely hurt the economy. Well, the tax cuts have led to larger budget deficits. That was anticipated, and that could have a long-term adverse effect depending on what else comes down the road. But one of the positives of the tax cuts is the corporate cuts, and particularly the accelerated depreciation, indeed the ability to expense capital goods and intellectual capital and premises, buildings. One of the things that was hurting the economy for a long time after the Great Recession was that business was extremely reluctant to spend on these things. And the tax cuts have contributed to much more enthusiasm on the part of business. In the last 12 to 18 months, we have seen a tremendous pickup. That could have very long-term positive effects if it persists. Well, the whole issue between Trump and the Fed is, from Trump's side, it's pretty straightforward. He wants nothing that will interfere with the rise in the market and with the pace of economic growth before this election and the 2020 election. The Fed is taking a longer-term view, and I think a more judicious view than the president is. Maybe not hard, but a more judicious view than the president is. The Fed is concerned with two things. One is to normalize rates. They've been doing this since Janet Yellen was chairman. Effectively, they want the rates back to normal rate levels relative to the economy. If something should go wrong with the economy right now, they have nowhere to go. Or actually, they have largely succeeded in that. There's a lot of debate about what normal is, but many economists would say, and I would agree with them, that normal would be short-term rates at about the rate of inflation. And we have that now. Long-term rates pay a little more than that. And that would suggest that the Fed is under less pressure to raise rates. The other thing that's going on here, which is a little more fundamental, is the Fed is concerned about some increase in inflationary pressures. They're well aware that they've pumped a lot of liquidity into the economy over the past 8-10 years to deal with the recession and very slow recovery initially. And they know that that has a fundamentally inflationary effect if it gets going. They're worried about an inflationary momentum taking hold, and they want to head that off as well. That is also why they're raising rates. Because rates have reached normal, I don't think the Fed's going to push it too far, too fast. They're not succumbing to the president's pressure. They're succumbing effectively to their own analytical perspective. It's hard to predict, but I would say that we will see another recession within the next 3 years. And I would come back to what I said about unemployment and capacity utilization. There just isn't enough room in this economy to continue growth at an adequate rate. Now, there are no financial excesses except in the federal government, which I think is a special case. I looked at the household sector. I've looked at the corporate sector. State and local government is always in a financial mess. That has never changed. So that's not a particularly new thing. There are no financial excesses, so there's no sign of an imminent recession. But this lack of capacity for growth, this lack of room for growth because of unemployment, even if we were to open the floodgates to the right kind of immigration, it would not be enough. That will cause another recession. And I will say, and this is always dangerous to time it, within the next 3 years.